Fernando. When you sell a call in stock that is growing, usually the volatility is low. So is it convenient to sell in a low IV range? Okay. Yes. I'm sorry, Fernando. That sounds like a ridiculous answer without getting into the volatility discussion, because here's the idea. You're asking me, a stock is growing. It's showing you the growth we want. The same criteria I mentioned that we would look for. We want a stock in an uptrend, good MACD. Been doing this. You say, oh no, the implied volatility is low. I can't sell against it. Who cares? And what I mean by that, let's see here. I'm not trying to be facetious, but what I mean by that is I've said this before. And let me clear the filters out, and I'm just going to walk through this cycle, this experiment with you real quick. I'm just going to go to standard December expiration, 14 days out in time. My plan, my trading plan for selling calls against stock either I own or stock that I want to buy, this is not my plan. This is not a recommendation. I'm saying I've already mapped out this plan. And I want to make 2% return on covered calls if assigned with a 2% downside protection, meaning I collected 2% against this current stock price every 14 days. I want good quality stocks that are in an uptrend, good volume, good open interest. I'm going to avoid earnings. Okay? So I'm going to go standard December. 2% downside protection, minimum 2% return if assigned. Not going to care about in the money and out of the money. Now, most of these are going to be at the money to get that 2% in 14 days. I'm not going to worry about implied volatility. I'm not going to worry about anything along those lines. All right, maybe I'll look for some good volume and some good open interest. Now, I cleared all the filters out, so nothing else in there. What else do I want? Again, I'm going to want a good average stock volume of 750,000 shares per day. Might use a good broker recommendation, but I am going to look for a stock that's in an uptrend above the SMA 20. And I'm going to look for a positive MACD. I want it to be at least 1 day over the signal line. Okay. Well, covered calls here, stocks to match my trading range. Let's put in just 10 to 150. 10 to 200. Okay. Market cap, this is measured in thousands, but I'm going to look for mid to large cap stocks. I'm going to go bigger than 2,500. I want a stock that's shown positive earnings per share growth, at least 5% over the last year to show good management. Might put in a PE ratio. And I'm going to avoid earnings between now and expiration. Excluding the expiration of 14 days, it's only 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and we count 11 criteria. Not that much. I've got some things I haven't heard of and some things I have. You've got Bluebird Bio, Arrowar, and so forth. Some of these returns are extremely high. I can tell you right now, those ones with the highest implied volatility are here and up, without even having the criteria there. Look, if the returns that you're seeing here are double what you're seeing down here, these are the ones that have the higher implied volatility. Look like a better return. They're matching the trend that I want. But something safer that's been moving up consistently, which is probably down here on page 5, is not going to have as much volatility, but it still matches my criteria. Insight Pharma, Canada Goose, not that's wrong, Alexion Pharma, Halliburton, okay? Some might consider these more stable, but they've got the lower percentage returns. Now, I know, I'm not dodging your question, Fernando, but here's my comment on this. I'm going to add some columns in here very quickly. I want to take a look at implied volatility. Oh, sorry, folks. I want to look at, not the volatility stock, I'm going to look at the IV over HV. And I'm looking for my other one's Black-Scholes ratio. Okay, I'm going to add those columns in. There we go. Okay. Now let me resend. Yeah, resend. All right. Now those three factors I entered into those positions, right? Let me go back to page 1 very quickly. Look at these. The IV-HV ratio, those ones I mentioned that were high, 2.45, right? IVs of 1.2, 1.3, 1.4. Returns double or triple what I was originally looking for. Okay, all of them are going to have a relatively low probability of signing because, as I mentioned, I'm going to be at the money with this criteria without even setting that range. Okay, Black-Scholes ratio, anything over 1 is considered overvalued. So, is Bluebird the top 4? Let me do this to clear it up. Let me just do one result per security to show a better example. All right, good. So you see a lot of those now. We narrowed it down to 33 results for the doubles, but a lot of these on the first page all have this, are considered overvalued, where the implied volatility is higher than the historical. And the Black-Scholes ratio, the actual trading price, is higher, and in this case, extraordinarily high. This is the highest rated overvalued, even though I'm not sorting by it, but I'm sorting by highest return, meaning that according to the Black-Scholes pricing model, the actual trading price of this option is twice the theoretical value. And the implied volatility of this option is 100 times more, 1 is equal. So it's 145 times above the historical volatility of the stock. Here's one that's undervalued, okay? Now, if you get this 9.2, 10.9, 10.1% return, it's the return if assigned, the percent if unchanged is 10.1. The downside protection is 9.2. It's more than double what I'm seeing with this option that's considered undervalued. What were my goals? A good quality stock that consistently I want to make 2% return or more on 14 days. Why is this double? Something's coming up that you probably can't see in the news. Bluebird, Arrowhead Research, they might have something such as a phase 2 or phase 3 drug trial coming up in the near future, which, worse than earnings, could cause the stock to drop 40 or 50% or to jump 20 or 30. Kind of a hard position to play with a covered call. It might be better with a different strategy, right? This one might not have anything coming up, but it does have good numbers and it matches my criteria. So where I'm really going with this is that if I have a structure that I know that's worked, with the return probability, the return potential I'm looking for, the time frame, the type of stocks that consistently show good profits, 2, 2.5%, 3% every 14 days with this sort of strategy. Although there's something out there that offers a higher premium because it's more considered overvalued because the implied volatility is higher, this has to be the better trade. Well, no. Long term, these tend to move against you more often, where you don't have the win ratio you expect, as you do with more quiet, less volatile positions. To your point, when you sell a call in a stock that is growing, usually the volatility is low, is it convenient to sell in a low IV range? Why are you holding the stock? Are you holding it for long-term growth? Are you holding it for premium? Are you holding it for a dividend? Long-term is a core position, which really is number one. You might be holding it that way. The reason why I mention this, Fernando, is that if you're holding a core position long-term because you want to collect the dividend and you think it's a quality stock, it shouldn't matter to you where the IV is. If you don't like the range, don't sell the call, but then you can also say that, well, you're going to own this stock for long-term. Even if the IV is low and the premium's low, might as well rent it out this month. Get something. It's better than zero. If you're looking at a position that you're holding long-term because you like the stock, Fernando, and your goal was to sell it to make 2% per month because you think it's a quality stock, and that was part of your whole trading plan, it's a portion of your portfolio for your whole trading plan, and right now that stock is not giving you what you set forth in your trading plan, maybe you should consider trading stocks. Do you see what I'm getting at here? What I'm getting at is that to me, it doesn't matter if the market considers an option to be overvalued or undervalued. I'm not really concerned by the fact that this potential covered call here could give me 2 or even 3 times as much return as some of the other ones on the list. I'm going to be looking for a stock that has the stock pattern that matches the strategy I'm looking for. And if I only make 2%, so be it. Because my plans were, and my trading plan that I developed based on the likelihood of success, the likelihood of loss, I might use that trade simulator tool in radioactive trading you've seen me use before, but I might put in those numbers of what my expected gains are, my expected losses, and how much I expect percentage-wise to lose on my losses and win on my winners to see if that would be successful long-term. So to me, I'm not too worried about the fact that, oh, there was something here that offered me a 10% return versus something here, M-chip, that's offering only a 2% return. Or National Oil Well. And here's why. Let me go a year with M-chip. Oh, I'm sorry, folks, got to draw a chart. A year with M-chip, now this has been all over the map, but it's had a good run from 70 up to 100. Did have a disgusting decline here, but I bet you that was, yeah, that's that May to June series where a lot of stocks were falling. Came back up, came back down, but even over the last 6 months, it's within 1 or 2% of where it was with a lot of hiccups in there in between. Now watch, this is going to prove opposite, but let me go back to page 1. Let's take a look at Bluebird. Okay, just in the last 3 months, it's down 20%. Sorry, 1 year. Good grief. Wow, it's down 50% from 160 down to 80 in that same time frame where we saw M-chip have some losses of about 15% during that May-June period, but right now is only 1% below where it was 6 months ago. This is 50% below. No wonder the implied volatility is so high. And yes, they probably do have a phase 2 or phase 3 drug trial coming up, which we can't see that because you don't know the date that's actually coming out in most cases. You can see that they are, or they have a drug in the pipeline that's phase 2 or phase 3, but you know that if it fails phase 2, it's going to drop 56. Well, this one's not. This one, Bluebird, I think, has dozens of things in the pipeline. It's the smaller companies they're running through that are going to drop to 60, 70%. This would take a 10%, 15% hit. But is this a type of stock you want to own and sell calls against just because the implied volatility is higher? And you can say to yourself, oh, well, it's had a 50% decline in the last 7 months, so it's bound to go back up. No, this could drop another 50% in the next 3 months. Hey, so could M-chip, for all we know. But that's the key. Would I rather have a stock that's more along this lines with selling calls against it, even though the IV is low, because consistently it has a lower risk tolerance than something that's doing this, right? That's the trade-off. So to me, if you're holding a stock, Fernando, and you're worried about selling into low IV range, I wouldn't consider that, because what's more important to you is the return giving you what you want for your trading plan, which should already be developed for the trade. Ask yourself why you're holding the stock. Is it because of the dividend? Well, then that call premium you're collecting is just a little bit extra. Are you selling it for premium because you want your trading plan wants to generate 2.5% per month, let's say, using out-of-the-money calls on this stock, but now you're not getting it because it's been moving up and it's in a low IV range? Well, maybe go further out in time. Maybe go an extra month, or maybe consider another stock if your trading plan is really strict that to hit the goals you want, you have to have that 2.5% return every 30 days. Otherwise, if you're just going to hold this stock long-term regardless, I don't care if you're selling, do you really care that you're selling into a low IV range, because you're still collecting something and getting some premium against it. Just naturally, of course, don't sell the call going into the earnings cycle, because if the stock jumps up 10 or 15%, it's going to cost you more to buy it back. Yes, what I'm really getting at is the double-edged sword of volatility. That is another webinar, an old webinar I have here that I've always been really fond of. It's in the options concepts section. Let's see here. I know it's back. It's an older one. Manage, options exercise, implied volatility, the double-edged sword. Okay. Why is it a double-edged sword? Well, let's think about it. Absolutely. Bluebird, Arrowhead Research, they're double everything else that's in these results. 9.2 and 8.3 for a 14-day trade versus 4.7, 4.6. What's the rule, ladies and gentlemen? If the return looks too good to be true, It probably is. Something is coming up on these two potentially in the next 14 days that could cause the stock to swing wildly. That's why the implied volatilities are so high. It's a future look of what could happen to the stock based on known or unknown events, usually known events. And that's sort of the concern there. The higher implied volatility points to something. And the downside protection, what you're collecting against the stock, why are these two double everything else? Is because, in theory, it's double the risk. What do I mean by double the risk? If I'm collecting double the premium, how can it be double the risk? If I'm collecting double the return or double the downside protection, how can I be doubling the risk? Implied volatility is sometimes referred to as what? A measure of fear. A measure of fear of the fluctuation of the stock in the future based on an upcoming event or something in the sector perhaps as well. So what it means is there's more chance of these two stocks fluctuating, let's say perhaps 10, 15, 12% in the next 14 days. That doesn't mean it's favorable. It could be 25% fluctuation to the downside. That's not favorable. 25% to the upside, hey, you get assigned and you're looking extremely happy. But if this gap's up 10% and you make the 10% return, and this gap's down 25% and you lose 17, that didn't work. That didn't work, did it? No. Percentage-wise, you're still down. You're still losing on those two positions. I'm not saying that 85% of these positions down here with the lower implied volatility are going to be successful. I'm saying what's important is your trading plan and the targets, and not getting hung up on this idea of finding the best and highest implied volatility and highest return, because those are usually the trades that get you into trouble and don't pan out long term. Ernie's testing bore that out. We needed all the testing for the monthly picks of the day and the weekly picks of the day. I'll be honest, they're a little bit higher implied volatility than I would normally trade for a covered call position. But he proved that looking for a higher implied volatility long-term over a 1-year, 2-year span was not as successful, and actually in some instances lost money because the fluctuations are too big. And you can't use a stop order to protect it because they happen overnight. Pre-market hours, it's down 30, 40, 50%. Sure, some of them went up 30, 40%. You made a 12% covered call return in 30 days. But those other ones, you got 10% downside protection, it dropped 50%. You're down 40%. Stop orders can't help that. And that's why it didn't pan out. Gamblers looing. You know, you get a 25% loss on a position, you need a 33% gain to get back to break even. If you take a 33% loss, say you got a 17% high implied volatility premium on a covered call, but the stock fell 50% because it was a biotech, you take a 33% loss, you need a 50% gain on what you have left to get back to break even. And by the way, once that event happens, downside or upside, what happens to this implied volatility? Goes away, goes back to normal. If this stock drops to, one of those $12 biotech stocks where you could buy the stock at 12, sell at $12.50 covered call 1 month out in time and receive $3 in premium, I saw those a few years ago. It was a biotech stock. One drug in the pipeline, phase 2, drug trial, failed, dropped to $1 per share. And someone said, oh, well, the implied volatility, I can still generate this almost 30, 25% return. No, the implied volatility dropped back to normal. It dropped back to 0.2 or 0.3. So now you're on a $1 stock. The $1 strike, if they still offered it, which mostly it was going to be delisted soon, but that $1 strike was only 10, 15 cents. It wasn't 30 cents. It wasn't even 25 cents, okay? So that's the risk with those higher IV stocks. If you're holding something, Fernando, long-term for growth and other outlooks, you can choose not to sell the call against it if the implied volatility is in a low range, or just take what you can get and move on. Don't worry about it. But if it's not meeting your targets, if you're holding the stock because you plan to generate covered call premium on it and earn 1.5%, 2% every 30 days, and you're not getting it, maybe reevaluate while you're still holding that stock. All right. Well, ladies and gentlemen, it looks like those were the top 3 questions that we had today. I didn't see any others come in. So I want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. Options, of course, do involve risk and may not be suitable for all investors. What I mean with that middle paragraph is I'm not planning right now on going and opening a calendar spread on Monday on LLY or opening one of the married puts we looked at today on, say, DBI, or doing a covered call on any one of those four positions we looked at with Arrowhead, Bluebird, National Varco, the oil company that we didn't really look at, and then the one that we did visit the stock chart on, Microchip, M-Chip. Okay, so that's what I mean by they're used for examples. I'm not placing any of those trades tomorrow, and I'm not recommending any of those trades for Monday. Now, today, you got a chance to look at search criteria for calendar spreads, diagonal spreads, what's called the poor man's covered call. We got to talk a little bit about the married put structure, using the custom spread tool to help us analyze the profit and loss. And we looked at setting up the covered call screen and sort of the warning and hesitation of the double-edged sword of implied volatility and looking for inflated premiums. You want to take advantage of any of the tools that you saw today, plus our powerful portfolio tools and other research tools we didn't look at in depth today. Simply go to powerop.com, put in your name and email address, and you can have access for 14 days to all of the tools and all of the searches for all 23 different strategies, plus much more. There we go. Our subscriptions after that start at $45 per month, but we have different varying levels of subscription if you wanted to go to different delayed services, historical services with access to the backtesting tools, which go back about 10 years, or the real-time service as well. Again, other free education you can check out this weekend, blog.powerop.com. Hey, that webinars page, we showcase 2 webinars that will be really important to augment our discussions. That one on the calendar spread criteria under the option strategies tab from March 15th, 2017. And of course, under the options concepts, that video on implied volatility, the double-edged sword. Of course, you'll probably see many other titles as you scroll through our webinars page that'll jump out at you and seem like really quality material. And believe me, they are. And they're all there for you to access. You can also check us out on YouTube at any time. YouTube.com, of course, user power options. If you think of any questions later on this weekend, remember you can email us at any time to support@powerop.com or support@radioactivetrading.com. You can also call us at 302-992-7971 during market hours. And remember, those of you on a trial or a current subscription, you can schedule the coaching sessions at any time. It's a 35 to 45-minute phone conversation with myself or Ernie, and we'll walk you through the tools on the site, answer any questions you have. It is not a sales call. It's just us kind of going through what we did today. You pose questions, or we'll walk you through the tools we think you're going to use to manage your positions as well. Well, ladies and gentlemen, I want to thank you for joining me today. Mark had a comment, says, along with your survey of how to use power options for calendars, some great trading and risk reduction advice. Well done. Thank you, Mark. I appreciate it, and I appreciated your comment there on the calendars for removing the earnings. I'm sure that would have opened it up a lot, but because of the risk of that leverage on that strategy, it's one of the ones I always tend to avoid earnings on between now and expiration. What I may do, this is probably a good topic I should add to the other discussion, and I'll probably filter it into that first discussion on calendars, Mark. A good thought there is that if I am doing a poor man's covered call and selling the premium against that long call long term, planning on writing it month by month by month, as I come up to the earnings, what I may do is buy to close the call I have open, hopefully for a profit, but even if it's for a little bit of a loss, leave the long call open and then buy a short-term put. Let it go through earnings. If it swings one way or the other, I can still take a benefit without the capped gain or the short call. And if it really falls, I've kind of got a short or long strangle in place. Then I can readjust the position and then continue the calendar spread to generate premium against it by getting rid of the put or manipulating the position that way. So that's if I am doing quote-unquote poor man's covered call for multi-months, knowing I'm going to have to cross an expiration cycle, I may leave the call out of that cycle, add an additional short-term put, hopefully for a cheap cost, just in case. The stock swings down, use the put to hedge the loss in the call. If it swings up, Hopefully I didn't give too much up on the put, and I continue to sell calls against it. All right. Ladies and gentlemen, have a fantastic weekend. We'll see you next week. You'll see a lot of emails from us next week going forward for some other presentations we're going to have. And we'll be back here next Friday as well, 4:30 to 5:30 p.m. Eastern Time. Take care, everyone. Good night.